Friday has come and gone. The options expired. The contract settled. The mechanical pressure that dominated silver's price action for the better part of this week has now cleared. And what happens in the hours and days immediately following a major silver options expiration, specifically this one, at this moment against this particular backdrop of COMEX vault pressure, May delivery dynamics, and a macro environment that has rarely been more consequential for precious metals is one of the most important and most misread windows in the entire silver trading calendar. Most investors breathe a sigh of relief when expiration Friday passes and assume the interesting part is over. They are wrong. In many ways, the interesting part is just beginning, and if you want to understand what silver's next move actually looks like after the deadline has passed, you need to understand what just changed, what did not change, and what the market is about to reveal about itself now that the expiration noise is out of the way. Let's get into it right now. The first thing to understand about the post-expiration environment is what has actually been removed from the equation and what has not. What has been removed is the mechanical delta hedging pressure from options market makers. All week, as we broke down in detail in our pre-expiration analysis, the price action in silver was being influenced, sometimes dominated by the continuous hedging adjustments that options dealers were making to manage their exposure as contracts approached expiration. Every move silver made this week triggered responding moves from market makers adjusting their futures hedges. That feedback loop created price dynamics that had nothing to do with fundamental silver supply and demand and everything to do with the mathematical structure of the expiring options book. As of Friday's close, that mechanical overlay is gone. The contracts are settled. The delta hedges built around them have been unwound. Silver's price action from this point forward is returning to being driven by the actual forces that determine silver's real value: physical supply and demand, macro conditions, institutional positioning, and the fundamental story that we have been tracking across multiple videos on this channel. That transition from options mechanical to fundamentally driven price action is the single most important thing that happens in the immediate post-expiration window, and it is why this period deserves focused analytical attention. What has not been removed, and this is equally critical to understand, is any of the underlying structural tension that existed before expiration. The COMEX registered silver inventory situation did not resolve itself because Friday arrived. The May delivery dynamics that we analyzed in depth are still playing out. The gold-silver ratio signal that fired with such historical significance is still active. The real interest rate environment that the indicator tracking 5 decades of precious metals bull runs is responding to has not shifted materially. The industrial demand revolution from solar, EVs, and semiconductor manufacturing that is creating structural supply deficits in the physical silver market is still accelerating. Options expiration was an event layered on top of all of those structural factors. It influenced price action around the margins, created short-term volatility and mechanical pressure, but it did not alter the underlying market forces in any meaningful way. Now that the expiration overlay has been removed, those underlying structural forces get to speak more clearly and more directly through price action than they could during expiration week. That is why the post-expiration period often produces the clearest fundamental signal of the entire monthly cycle. And right now, that signal deserves your complete attention. If this post-expiration framework is giving you clarity on how to think about silver's next move, please hit that like button and subscribe to this channel right now. This is the ongoing, connected, deeply analytical coverage of the silver market that we build every single week for this community. Let's talk about what the options expiration result itself tells us, because the way options expire carries information that goes beyond the mechanical unwinding we just discussed. The key question is where silver's price settled relative to the maximum pain level, that strike price at which the largest number of option contracts expired worthless. If silver closed expiration Friday at or near the max pain level, it tells you that the gravitational pull of options market maker hedging was effective. The market's mechanical forces worked as they typically do, pulling price toward the level of maximum option value destruction. That is a relatively neutral signal. For the post-expiration direction, the mechanical pressure pulled price to max pain, and now that pressure is gone. What happens next is genuinely open and more purely driven by the fundamental picture. But if silver deviated significantly from max pain at expiration, if price closed well above the max pain level despite the mechanical downward pressure that typically constrains rallies into expiration, that tells you something very specific and very bullish. It tells you that the fundamental buying pressure was strong enough to overcome the options mechanical headwind. When organic demand overpowers mechanical suppression, the post-expiration release of that mechanical constraint can accelerate the move that was already in progress. The market was rallying into expiration despite the headwind. Once the headwind is removed, the rally can run more freely. Conversely, if silver closed well below max pain, it may signal that selling pressure was strong enough to push through what should have been mechanical price support. A potentially bearish post-expiration signal. Reading where silver actually closed relative to max pain is therefore the first analytical step in understanding what comes next. Now let's walk through the specific post-expiration dynamics that experienced silver traders watch most carefully in the hours and days following an expiration event like this one. The first is what happens to open interest as expiration-related positions are fully unwound and new positions begin to build for the next contract cycle. Open interest in the front-month silver futures contract typically drops sharply immediately following expiration as the contracts that were being held in connection with options hedging are closed out. But then, over the days following expiration, open interest in the new front-month contract begins to build as participants re-establish positions for the coming period. The pace and direction of that new position building is one of the clearest reads available on where institutional conviction is pointing. If new long positions are building rapidly in the post-expiration open interest data, it tells you that the smart money rolling into the new contract cycle is positioning for higher prices. If new short positions are being established aggressively, it tells the opposite story. Watching the first few days of open interest reconstruction after expiration is like watching the smart money vote with real capital on where they think silver is heading without the noise of expiration mechanics distorting the signal. The second critical post-expiration dynamic to monitor is the continuation or reversal of the COMEX vault trends that were already in motion before expiration week. We have been tracking registered silver inventories, canceled warrants, and the eligible to registered conversion rate with particular intensity given the May delivery. Backdrop expiration week can temporarily distort these numbers as positions are shuffled around in connection with options and future settlement. Now that expiration has cleared, the vault data in the coming days will give us the cleanest read yet on whether the physical supply tension we have been documenting is continuing, intensifying, or beginning to ease. If registered silver inventories resume their downward trend in the post-expiration sessions, it confirms that the drainage we were seeing was genuinely driven by physical demand rather than expiration-related technical factors. If inventories stabilize or begin rebuilding, it suggests some of the apparent tightness was expiration-related positioning that has now resolved. Either outcome is informative, either outcome helps you calibrate how urgent the physical supply story actually is as May deliveries continue to play out. The post-expiration vault data is your first genuinely clean read on physical supply conditions since expiration dynamics began influencing the picture earlier this week. Let me address the technical picture specifically, because the post-expiration period is also when technical analysis regains its reliability as a tool for understanding silver's near-term trajectory. During expiration week, as we explained, price moves are partially driven by options hedging mechanics that have nothing to do with the technical structure of the chart. A support level that holds during normal conditions might be broken by expiration-driven selling pressure and then immediately reclaimed, creating a false breakdown signal that burns traders who acted on the technical break. A resistance level that should cap a rally might be briefly pierced by expiration-driven buying and then give back, creating a false breakout that traps momentum buyers. The technical signals generated during expiration week are therefore less reliable than those generated in clean market conditions. Post-expiration, that reliability returns. The price levels that hold or fail to hold now are being tested by genuine market forces rather than mechanical hedging flows. A support level that was tested and held through the post-expiration return to fundamentally driven trading is a much more meaningful technical signal than the same level holding during expiration week noise. Watch where silver's key technical levels sit in the immediate post-expiration sessions and pay particular attention to whether price gravitates toward them, tests them, and how it behaves on contact, because those reactions are now telling you something real about the underlying balance of supply and demand forces in the market. Here is something that many silver investors overlook entirely in the post-expiration period: the options positioning in the next expiration cycle and what it reveals about where big money is placing its bets for the weeks ahead. The moment the current options cycle expires, the next cycle becomes the relevant one for options market dynamics. The strike prices with the heaviest open interest in the next expiration cycle tell you where option sellers, who are typically better informed about expected price ranges than speculative buyers, have concentrated their exposure. The distribution of call versus put open interest in the new cycle tells you about the directional asymmetry of professional options positioning, and the implied volatility embedded in the new cycle's options. The premium that the market is charging for silver options relative to realized volatility tells you about the market's aggregate expectation for how much silver will move before the next expiration arrives. High implied volatility in new cycle options tells you professionals are pricing in the expectation of large moves. Low implied volatility tells you the market expects relative calm, given everything happening right now with COMEX inventories, May deliveries, macro signals, and the ratio dynamics we have been tracking. What the new options cycles implied volatility is saying about expected future price movement is an important data point for calibrating how aggressively to position in the current environment. Let's zoom out from the mechanics and talk about the bigger picture narrative that Friday's expiration was embedded within, because the deadline that just passed was not just a technical event on the options calendar. It was a milestone in a larger story that is still unfolding, everything we have been building across multiple videos. On this channel, the gold-silver ratio reset, the real interest rate indicator firing, the COMEX vault pressure, the May delivery dynamics, the Samsung and Tesla industrial demand revolution, the PPI and Beige Book macro signals, all of it is part of a coherent, connected thesis about silver being at an extraordinary structural inflection point. Friday's options expiration was one chapter in that story, an important chapter because it concentrated mechanical forces that temporarily influenced price action, and because the way it resolved carries information about the underlying strength of the market. But it was not the climax of the story. It was not the moment of resolution. The structural forces driving silver's longer-term trajectory are operating on a time frame of months and years, not days, and those forces, the supply deficit, the industrial demand surge, the monetary environment, the positioning dynamics, did not pause for options expiration and did not resolve when Friday's bell rang. What Friday's deadline did do, and this is perhaps its most important function from an investor's perspective, is reset the clock and clean the slate for the next phase of silver's price discovery. Post-expiration silver is like a river after a temporary obstruction has been removed. The water was always flowing, the current was always there. The expiration was a temporary narrowing of the channel that concentrated and distorted the flow. Now that narrowing has been removed, the river can spread back out and find its natural course. Where that natural course leads and how quickly depends on the balance of forces that were always present beneath the expiration. Noise. The registered inventory trend, the delivery demand from May futures, the macro backdrop, the positioning of large speculators and commercial hedgers, the industrial demand pipeline, the global real interest rate environment, all of these forces, unobstructed now by expiration mechanics, will drive silver's price action in the coming sessions. Reading them clearly, which the post-expiration environment now allows you to do more cleanly than at any point during the last week, is the analytical task in front of every serious silver investor right now. The practical implication of everything we have covered today comes down to a simple but important point of discipline. Do not make the mistake that many retail silver investors make in the post-expiration period, which is to assume that because the expiration event has passed, the interesting dynamics have passed with it. The opposite is true. The expiration was the noise. What comes after is the signal. The next several trading sessions will reveal, with unusual clarity, where the smart money is actually positioned for the weeks ahead, whether the physical supply tension in COMEX vaults is genuinely structural or was partially expiration-related, whether the technical levels that matter most are holding in clean market conditions, and how the macro narrative that has been building is being reflected in silver's price behavior now that mechanical distortions have been removed. Pay close attention, ask the right questions of the data, and understand that Friday's deadline was not an ending, it was a clearing event that makes the next chapter of this silver story visible in sharper focus than it has been all week. Leave a comment right now and tell us, did silver's behavior this expiration week match what you expected based on the options dynamics we laid out in our pre-expiration video, or did something surprise you? We want to hear how this community is applying these frameworks in real time, because your observations and experiences make every future video sharper and more useful. And if you know a silver investor who watched the expiration week volatility and came away confused about what was driving the price move, share this video with them right now, because understanding what just happened and why is the foundation for understanding what comes next and what comes next for silver. If the structural signals we have been tracking are reading the market correctly, is worth paying very close attention to. We will see you in the next one.